So I'm up on Mount St. Helens.
Okay.
All the geeky stuff is happening. Now we finally get to talk about it. The Federal Reserve, inflation, CPI, and what it means for real estate investors, like where are interest rates going? CPI measures price changes and a volatility in these price changes and what a consumer pays over time. So CPI came out this week and it came in at 4%. Now, what really happened there was we had this base effect drop off. Consumer price index is actually, it's an aggregate. It's January, February, March, or wherever you're at. It's the last 12 months. It's what did that change in price happen for that month, for the next month, and then they add it all together. We had the second largest month. We've talked about this on previous episodes. If you want to go check them out, just go check them out. But the base effect, the second largest month just fell off. So we had a 1% in June of 2022, and that was replaced by 0.1. I had to look down in my notes to make sure it was the exact number. That means the CPI for this month changed by 0.9, 1% minus the 0.1. That's why it dropped so much. See, everyone looks up and they go, we beat inflation. I'm sorry, we didn't beat inflation. We're going to get into that next with the PCE and then also with what the Federal Reserve said, but we didn't beat inflation. The base effect, that rolling off, looked really good, but it's still sticky with us right now. Next month, we're going to come down into the low threes and everyone's going to be like, we won the battle. So next month, the base effect is 1.3 is what's rolling off. With the 1.3 that's rolling off, we'll get down into the low threes for CPI. The problem is the stock market was already starting to respond positively and people were starting to expect interest rates to go down. We're wanting the Fed to pivot. We're wanting the change. And I'll be honest, I was a little emotionally disappointed too. I'm up on Mount St. Helens. We're out hiking, with my son and his class, and all this economic news is happening. I have no cell phone signal. I feel like the kid that's lost out there in the forest, and I can't figure out what's happening. Get a text message from you. Are you eating popcorn? You ready to watch? No, I'm not ready to watch. I have no internet. What we're really looking at, and this is the but, is that we need those inflation numbers to be about 0.2 or less. So 0.1 to 0.2 every month for it to add up to less than 2%. Remember, the Fed's target is 2%. So 0.1 was great this month, and that base effect of 1% rolling off, great. But we've got to continue this trend. And then PCE has to continue this trend too. See, because the average consumer, and what the news always talks about, is PCI. What the Federal Reserve measures inflation against is PCE, the personal consumption expenditures. The problem is that one is showing more hot than PCI. And so the Fed's actual metric, the thing that they're going to use to lower interest rates, is showing hotter. The chart that you're looking at above there, that's the base effect of every single month. So when you look at PCE, we take out the core, we take out food and energy because they're more volatile. The problem is that PCE has been hovering since December between 4.6 to 4.7. So even though PCI, we had the big number drop lower, the Fed doesn't care because their preferred metric, not what the media reports, is saying that it's still running a little hot. So just like we talked about in previous episodes, inflation is sticky. This is going to take longer. This was emotional to me personally because I want the Fed to pivot. I want lower interest rates, or I want a hardcore recession. I either want a hardcore recession or lower interest rates. Lower interest rates make my deals cheaper. Hardcore recession, make the prices cheaper. I just want to buy more real estate. With PCE not going lower, the Fed, so they had their Fed meeting, and everyone is, we talked about it last time, the expectation was the pause. But what the market wanted emotionally, and what I want emotionally, is the pivot or the change. In other words, we want interest rates to go back down. What we forget is long-term inflation is really sticky. 2, prices do not move fast. They move really slow. 3, because of these cell phones and this digital era, we just expect everything to happen overnight. It's like the microwave takes too long when you put the microwave popcorn in there. You're like, come on, 2 minutes and 30 seconds. It's just too much. The economy doesn't move that way because it's so big. So the Fed then comes out, and they did give us the pause we were looking for. However, Jerome Powell came out extremely hawkish. And quite honestly, if you really watched his body language, this was your tip. You said, hey, pay attention to the words. We'll talk about it tomorrow. Felt almost like he was lying, or it was emotional, or he didn't like the numbers, or a little flippy floppy. But he came out and he kind of just pounded the shit out of us. And so he said, well, I'm giving you a pause. And then there was a giant but. We may do 2 more rate hikes this year. The dot plot from the Fed came out and said the Fed fund terminal rate might end at 5.6. And so it's like Jerome Powell and the rest of the Federal Reserve are kind of in slight disagreement. And that's why it seemed like during the press conference, he was talking about maybe 2 different issues. Maybe part of it was his opinion, and then part of it was the opinion of the Federal Reserve. And you can tell that he wants to win, and he wants to be done with inflation, but he's not quite getting the number he wants. So he gives us the pause and says, but he leaves the door open for 2 more rate hikes, and then hawkishly talks the market down so that the stock market doesn't go up, because remember, PCI came in great, but his other main indicator, PCE, is not where he wants it. So he has to come out, beat us up verbally, say, hey, rate hikes are still a potential in the future, and that we're going to be there higher for longer, when the general public, all we wanted was a pivot or a change. So, prediction. We are not going to get our interest rate drops this year like we wanted. And I know we've kind of already been alluding to this. I'm ready to bet money on it that we're not going to get drops now until 2024. Second prediction. There's actual possibilities of rate hikes now in the future. Before this meeting, I did not think that was a possibility, and I thought there was a possibility we'd get lower interest rates by the end of this year. Nope, he threw it out the window and talked the market down and was very hawkish. Third, in this case, I think Mr. Powell and the Fed as a whole is starting to break apart. They're starting to see fractions inside of it where they're having different viewpoints on the data. And that's why during that press conference, he kind of seemed to vacillate a little bit back and forth. Lastly, what this means is it means more deals are going to pop up, because if rates are going to stay higher for longer, that means people who are in short-term debt are running into problems in both a refinancing perspective, and like we talked about last time, credit conditions are going to keep continuing to get tighter, which means more deals are going to continue to pop up. Also, with the Fed being very hawkish, it creates more fear in the market. So the unskilled investor, they start to just slowly back out. Only the hardcore investors are playing today. We got a deal yesterday at like 8 p.m. at night with 7 years of 5% interest only owner financing, 4% in year 1, years 2 through 7, 5% interest only, with the option to buy another 3 years at 5% interest only with $50K balloon towards the principal.
That's better than the bank.
That's multiple percentage points better than the bank. It's a fourplex, and it's got high density multifamily zoning on it.
Should investors start calling you?
People need to start calling us now, and we need to start hunting for deals now. That is the longest term investor financed deal we've ever gotten. I've never gotten a 10-year potential owner finance deal, not even in the Great Recession.
Why is that happening, and is it going to happen more?
Fear. The Fed beat us up. Emotionally, it kind of stung. You know what? I drove down the mountain from Mount St. Helens, all excited. I was like, oh, come on. If you get the internet, everything starts beeping. And I was like, nope, that's not what I wanted. Put the phone down and just ignore it. It's going to continue to happen more because the inflation is going to be stickier than people want it, which puts pressure on people's cash and people's cash flow. In this particular situation, the person's burned out as being a landlord. They don't want to pay a bunch of money in taxes, but they still want the income coming in. So the long-term financing works. And our you only got to put 25% down in this case. They would have done the deal for 20% down. They would have done the deal for 10% down. This took 14 rounds of negotiation. So this was not an easy deal by any means. But yes, they would have taken it 10% down, but there would have been a higher interest rate. And they would have taken 15% down, but then it would have been a shorter term. At the 25% down, we're able to get this unbelievably long term. With this unbelievably long term, what that means is we can wait for the land value to exceed the structure value. Then we can just build multifamily in its place. Dozer scrape the fourplex off of there and turn around and build, somewhere between 12 to 14 units in its place.
So are more of these opportunities going to pop up because of the environment?
They have to. When this fear happens, it causes people to stop. And then also more people are just getting into cash. Okay, now I'm not saying don't be, go be stupid and leverage everything you own. Still buy, but be cautiously optimistic. But you need to start hunting for the buy. The buys are happening right now, and they're going to happen from now until the end of 2024. And then as soon as we get an election, it doesn't matter who gets elected, but as soon as we know who the next president is, the market will start picking up from there because, like we said before, I believe interest rates will also start going down. So you've got a twofold thing that happens there. You have economic certainty due to the presidential election in 2024, and then you have interest rates going down. So the hardcore investors, you need to start going today. Okay. If you're in a position though where you're in floating debt, you need to figure out how to get to permanent debt as fast as humanly possible because like we talked about in the previous episode, credit tightening, debt service coverage ratios, things like that, they're going to get worse before they get better.
Wow. A lot there. So funny. My whole experience was totally different, but I have a few questions. During the Fed meeting announcement Q&A session afterwards, usually that's where the gold nuggets are, right? Rather than the actual rate itself. One of the questions I was asked multiple times because I watched it is reporters asking if you are forecasting potentially 2 rate hikes or you think that there's still inflation to fight, why even pause? Why not just rip the Band-Aid? What was his general response, and what do you think is the real reason they pause now versus just raising it and getting it over with?
So usually before this, you and I have a chance to chat. I want to know your thoughts, and then I'll give you first.
Okay, you want to know my thoughts?
Yeah,
totally. You want to know my thoughts about the whole thing? Okay.
The whole thing, number one, and then number two, I want you to answer that question before I do.
Hey, this is going to go on record, okay? Because I feel like I do have a completely different perspective. I, too, was a little disappointed in the pause because I wanted him to just continue raising rates. Like you, what I know is if they continue raising rates to do what they're trying to do, which is fight inflation.
Yes.
Because regardless of the metric that looks better, the one that's more important, that's telling them, hey, just raise the rates, okay? If they do that, it just weeds out everything. It just cleans it all up, rips the Band-Aid off.
It's the literal forest fire.
And what you just said, deals are going to be there. Prices are going to come down. Yes, there's going to be some pain, but I'd rather have the pain happen right now for everybody versus uncertainty long term. And another thing that stuck out to me, he said this in that Q&A session, he forecasted when he thinks inflation numbers will drop and the actual numbers. So he says by the end of this year, we could be, potentially in the 4s or something like high 4s or mid 4s. He says by next year 3, and then 2025 finally 2%.
Yeah.
So if he's saying that right now, it's like, okay, the logic, if their tool to fight inflation is raise rates, why not just raise rates? So when those reporters asked that question, I was like, yeah, why wouldn't he just raise the rates? Why would he pause? My theory is there was other voices, other variables that was telling him and his team, hey, we need to just kind of see where the dust settles right now because we did have some of these banks, like failing. We have a whole bunch of questions that we kind of need to answer first. And guess what? Let's just wait. Let's just see what happens, right? Yes. And so what's interesting is they don't have that many tools. Lastly, the reason I believe it's important for them to raise rates is they're the ones that caused this with low interest rates.
For too long.
The only way to fix a problem you caused is to fix the problem you caused. And so the longer they put it off, they're just kicking the can down the road farther and farther. So my thought is they should have raised rates. And this is just me looking at like general, basic, elementary logic. They should have just raised rates and got to the point where they really saw the cracks, stopped, fill things in, wait, and then drop fairly soon afterwards. My theory about what is going to happen, I think they are going to raise rates a little bit more, because him being hawkish could have been partly to like tell people, hey, we're going to be aggressive here, right?
Yes.
But I think really he's also showing his true colors. Like, my job is to get inflation down, because until you get inflation down, and then you talk about the Volcker days in the late 70s, 80s, where they went up to 20+%, he's thinking like, hey, I need to squash this because that is my responsibility. Come hell or high water. You get what I'm saying? Like, he's like gonna do it. So he's gonna continue raising rates until something really bad happens. Because guess what? If you think about it, that's when they have pivoted in history, right? They just wait till that happens, even when they don't know they're waiting. So I think that's gonna happen. Well, this is the questions I have for the follow-up. I believe house prices are going to still come down slightly, even with inventory still being low, right? Because people are just like, I don't want to buy this house at this interest rate. And sellers are going to need to have more options, hence why they're going to get creative. And eventually there's going to be a break, because on the economy side, businesses are going to continue laying off, getting tighter, right? Just like the lag effect, there's going to be this lag effect of like people making these decisions. We won't see the results from those decisions in terms of layoffs till like a year down the road. So it's going to come all together by the mid 2024, end of 2024. And this was scary to me. It wasn't about like me feeling uncomfortable. I was like, this is kind of scary. We won't really have clarity till 2025.
Oh,
that's
100%.
A year and a half away, right?
Yes.
Based off of what I think they should do and what he was saying he should do. So that's why I'm surprised that you're like the opposite. You want it, of course, naturally. And this is where like I'm curious your perspective really about like as a real estate agent, because you know, I know you want to tell the truth and give good advice, but at the same time, your business relies on people wanting to buy, wanting to sell. So it's like a balance between like what you want generally and also what you know should be done. For me, I'm just like, rip that Band-Aid off. So yeah, like go back to the question about why is he pausing? If he's already forecasting there could be 2 in the future, why not just do it now and get it over with?
I think he had to talk us down and be hawkish. So the 2 in the future is the threat. And, you know, sometimes it's just the threat from dad. I'm going to take away your car keys, I'm gonna take away your cell phone. If you don't perform, I'm taking that away. So I think dad was threatening us, number 1. Number 2, Jerome has talked about this in previous meetings. The lag effect from the data shows up 2 months, 3 months, 6 months later. So the Fed is trying to be better than they have been in the past about telegraphing where they're going, about telling the market. So the market was expecting the pause, so they followed through with the pause. Now them saying we may raise in the future actually reopens the deck, allows them more cards to deal, and makes it so that Jerome Powell and the Federal Reserve isn't backed into a corner. So to be honest, even though I didn't emotionally like it, I thought it was a masterful move. Flip over to the journalism side. I loved how he got pounded 3 times on the same issue.
About pausing versus just doing it?
Exactly.
3 different ways they asked it, but the same question.
The same question. That was good journalism, okay? Because the American public has the right to know that. And the answer is inflation is sticky. They need to figure out what's breaking. Going back to what we've talked about in previous episodes, we know banking's breaking. We know commercial real estate is breaking. We know parts of manufacturing and supply chains are breaking. But we still know we have an undersupply of labor. We still know wages are growing, slightly faster than they want. I don't personally want that. I want everyone to make more money. It's just the Federal Reserve has a weird way of measuring, inflation can't, or wage inflation can't go up, greater than 3% a year. And it's going up greater than that after being stagnant for many, many years. So I think he had to use his voice, but he also, by giving room for rate hikes in the future, reopen the deck that they could do that and they could save face. See, what the Federal Reserve doesn't want to do is they don't want to be so far away from the general consensus and then make a mistake that they lose the confidence. See, with the dollar being the reserve currency of the world, there has to be confidence behind it. So I thought he portrayed very confidently, hey, we're a strong economy, we're moving in the right direction. That PCE though, and it's still being between 4.6 to 4.7 and just kind of bouncing along, that's really why he left the door open, is they have to get all of those numbers under control, not just the PCI. But see, the general public only looks at the PCI, and that's all the media reports. Lastly, going back to what you were saying, you said, hey, should you buy, should you not buy, or now is the right time to buy. I think for people having life events, the good life events, marriage, babies, things like that, the bad life events, death, divorce, loss of job, life events will naturally always cause real estate to happen. You shouldn't delay buying a home because of one of those, or selling a home. You should probably just get it done. If you're not doing anything with your money, you should park it in real estate. One of our old investors, I love what he said. Well, the dirt bank has never failed me. It's a great way to protect. It's never gone to zero. They're not making any more of it. There's one Earth. I mean, Elon might get us to Mars, but that's still a ways off. Lastly, when it comes to the investing side, there's always a good time to buy a good deal. Doesn't matter if the market's up, down, or sideways. If the numbers make sense and you have prudent reserves, buy the deal. Just stop speculating. And we've seen that. I would say most speculators are gone. They've been washed out, or they're losing money currently, or they're just afraid. You can't bet, like you said, the market's going to mildly appreciate here in the Seattle metro and in some other metros, but parts of the U.S. are still going to go down. You're not going to have a super strong market until interest rates come down, but we've got a decent enough market here that we know you're going to appreciate. And so if you had $100,000, you could keep it in the bank, and you could lose 5% of that to inflation, 4%, depending on the measuring, the metric we're looking at. And then in 2024, you have 96,000, 95,000, in dollars that are spendable, even though you still have this $100,000. Well, if you just went and bought a $100,000 piece of real estate and the market appreciated at 3%, which the Seattle metro is going to outpace 3% this year, and quite a few metros throughout the U.S. will. Well, all of a sudden at the end of the year, I've got something that's worth $103,000. Well, we've already appreciated more than that. So we're already at like 8%, 9%. Well, that means my 100 is essentially 109. So which would you rather have? Would you rather have 95,000 and the money's still in the bank, or an asset that's worth a little bit more? Please keep prudent reserves. Don't go spend all your money. And don't be so fearful. So this fear is what's creating the opportunity. Once again, going back, we just got an owner finance deal for 10 years, interest only. That's phenomenal. You only see opportunities like that in markets like this. Go get some.
So two takeaways from everything you're saying. Number one, as a seller, it's a great time if you own the asset free and clear, of course, or maybe own a whole bunch of assets. You can be the bank and create opportunities for those investor buyers who can't get the lending. On the flip side, as an investor buyer or somebody looking to get into real estate, if you're willing to get creative and you can work with people like yourself, right? Antons of the world, agents that understand these kind of, what do you call them? Like creative financing situations, you could actually buy in a like off market situation. And it might actually be a better deal long term than the hottest part of the market before, with appreciation going up 5 or 10% a year, which that's kind of the lesson, I think, that we don't want that. We want it to be a little bit more stable. Yes. They say every year 4% is like the historical high. In fact, I know this going off of a tangent. I was watching Saks Realty. It's a real estate channel. And I think they're based out of the East Coast. They had a guest on and they made a really good point. They said the historical average appreciation of real estate is 4% every single year. That is just
nationally.
Yep. Okay. Obviously, it can be higher or lower, but in the last few years, it was ridiculously higher.
Ridiculous.
So it was like 10, 15, 20%. This is why it doesn't matter what the Fed does. That has to get balanced out, right? So lower appreciation. But what you're saying is look at the whole situation from like a grand view. It's not just the lower appreciation, right? Or potentially lower margins. Also, what are you losing to inflation in the bank account? At the end of the day, real estate outlives all those variables because one, if you buy an asset, it could rent out, right?
Yes.
It could actually make you some cash flow. Two, that appreciation right now might be a little bit lower, but long term it's probably going to be higher, at least potentially 4% based on historical averages. And then three, you're protecting yourself from loss from inflation, right? Which is your money isn't worth as much, but your house will actually hold its value. And that's why an asset is always better than cash in the bank, as long as it's working for you.
A good way to think about it is opportunity cost, is by not purchasing an asset and cycling your capital and getting your capital to grow. Because we didn't even talk about leverage. So really that $100,000 would buy you a $400,000 or $500,000. We just mentioned it was in cash. So if it bought you a $400,000 and the market appreciated at 4%, there's $16,000 right there. So leverage is one of the great, wonders of the world. And in real estate, it just works over and over again. But what people sometimes fail to realize is just the long-term opportunity cost by not having the money working. Money works because it's compounding and it's uninterrupted and it keeps going over long periods of time. Well, every time I pull the money out and I just set it off to the sideline and it's sitting there in the bank, it's officially interrupted. It's officially not growing. And so that's slowing down your overall return. Once again, don't be stupid. And yet, keep it growing, because if you slow down its growth, you don't get that wonderful compounding effect.
All right. So one of the reasons why home prices are continuing to stay stable, and in some cases, Seattle area go up, which is nuts, considering the conversations we had last year, is inventory is so low, right?
Yep.
So my logic is, well, if inventory is low, wouldn't this be an opportunity for developers and builders to come up with the supply? Why aren't they doing that if that's the case?
There's three things that they're fighting against. They're fighting against sellers. So let's just be on the developer side for a second. Sellers who still have prices from 2022 in mind, because those did readjust.
So land, you're saying?
Yes, some of those lot values readjusted. We just did some work for a developer who was going to retrade. Retrade is a term for renegotiate a deal, and we showed development lot prices had moved 18 to 24% in Bothell. So in other words, they went up and then they peaked, and then they came back down. The problem is that some people are still at the peak. So one, they can't buy it cheap enough. Two, there's not enough buildable land in the buildable lands inventory to create enough supply. Washington State specifically is controlled by the Growth Management Act. The Growth Management Act establishes the UGA, the urban growth areas, for our cities and the counties. All of the UGAs were not expanded, which didn't bring more buildable land into the inventory. So let's just say there's 20 lots total. We know there's thousands, but let's just say it's 20. If those 20 have been in the UGA already for a few years, has everyone already talked to them and offered them money? 1,000%. So in other words, those people are not in a realistic price range to sell, or they just don't want to. They love living there. Buildable lands inventory believes that everything is going to sell inside of it. That's just not the case. Try to get 10 people to agree to anything. The next part of it too is a lot of the municipalities are still working from home. And when you're doing a large scale development project, that requires traffic, the wetland people, and I'm talking at the city or the county. The traffic engineer has got to talk to the fire engineer. The fire engineer has got to talk to the civil engineer, and there's different levels of civil engineers, and they got to talk to the landscape person, and they got to talk to the wetland biologist, and all of this has to coordinate. Well, working from home, they're lacking that kind of natural, easy, creative flow and process to be able to just walk over to Benji's desk and be like, hey, I'm looking at the project here at 123 Main Street. We've got this, this, and this. How do I check it off?
Summary. Permitting is just taking way longer than it should be and is a headache.
The permitting development process right now is a nightmare and is absolutely screwed up in the state of Washington.
Is it way worse in 2019?
Way worse.
Like percentage-wise, or I guess like how much longer is it taking?
30%.
30% more time.
30% more time.
Yeah. See, when I hear that though, I think, well, then that just means somebody who's willing to put in 30% more work would get the opportunity, right?
I'm like excited. Massive opportunity for the small builder, developer, and even the big boys and girls. Massive opportunity on the affordable housing side. Teeny homes, tiny homes, manufactured homes, small structures, okay? Find me a builder that's putting out 1,200 square foot houses. They don't exist in our area. Massive opportunity to flip. See, flipping got so out of control there for a little while that, because appreciation was happening so much. But if you could find a nice home, not at the luxury side, but a nice home and turn it over, the demand is there for it. One of the points you were making earlier, though, in the podcast, which should be very clear, is because interest rates are still hovering near 7, all of our demand is not there. And so if I start a development project today or even a long build, I'm actually going to be in the sweet spot, because if I look a year out, let's say it's a construction project, that puts me in mid-2024. That's a great time.
I mean, you and I both know your development project might not be done till the end of 2024 or maybe beginning of 2025, right? Which, if based off of what we're projecting and what even the Fed is saying, right? Because ultimately the winning number is 2% inflation, and they said 2025. Well, there you go. Right now is the time you want to start.
That's the whole thing. People want to start when they think everything's good, but you got to look into the future a little bit.
Everyone else gets in when it's good, right?
The Fed is telling you they've paused interest rates. We still have a great base level demand. I think it was in a Fortune article by Lance Lambert. He said, and I forget the number, but it was something like 90% of all major metros are appreciating right now. So the vast majority of the U.S. is appreciating. If it's appreciating in the face of a recession, rising unemployment, and a low inventory, it's game on, especially for your long-term stuff. If you start a development project today and you don't get it out of the ground until 2025, who cares? You're golden.
One thing that you said, I think that confuses people, because I know it would have confused me a year ago, was how is it that if the economy is slowing down, people are losing jobs, right?
Yep.
And interest rates are super high, way, 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 way higher than it was just like 2 years ago even, okay? And there isn't as much demand because people can't afford these new payments. How is it that house prices are going up? And my simple answer is we printed a lot of money that is just working its way through the system. A conversation I have with business owners a lot is how much cash they have parked. Yes, there's businesses going out of business and, people are laying off, but there's secret money just waiting to be deployed. And what's interesting, and this is one of the reasons why I always push you to do this podcast, they need to just get off their butt and do something right now. Because once everyone gets in, you want to talk about appreciation right now in this weird time. Imagine when the interest rates go lower.
Bingo. And
that money starts going back into the system, we might actually see another crazy appreciation.
You're going to see a real estate bull run.
And that's not when you want to get in.
No, there's no way around it. Because what the U.S. housing market just showed you is even at almost 7% interest rates. So we are, transactions are down 30, 40%, depending on what you're looking at. But 30, 40% less transactions, you're still seeing appreciation. That says the base level demand, the have to moves, the have to rents, okay? Not the want tos, but the have tos is enough to keep the housing market moving. If the have tos are enough to keep the housing market moving, it's time to start betting and going in today. You take some of that cash off the sidelines and just shove in. You don't have to take all of it, and I don't want you to take all of it, but it's time to put some money into the market and starting working. One of the largest developers in the area, one of my very good friends, says, I'm a buyer. It's time to start buying. Well, I'm like a destroyer. He's an aircraft carrier, and the destroyer follows the aircraft. So if the aircraft carrier is going, I'm going. And if you don't want to go, that's your own choice. But when we're starting to get deals and you know that the Fed is nearing the end of its cycle, who cares? The best terms are negotiated and the best deals are made when things are uncomfortable and there's motivation. If a seller has no motivation, they have no reason to give you a deal. We need the motivation. Lastly, it's mind-boggling, but because the market is appreciating, even in the face of those things, there's still that cash sitting there like you talked about. You can go look at the M2 money supply graph, and you can see how much cash is still out there. It only went down. I'm talking like a smidge. So even though the economy is tightening and things are breaking, the amount of cash on the sidelines is unbelievable. And that cash is slowly starting to trickle. Now, maybe you need to wait 30 days, 60 days in order to do this, a few months, 6 months. But as that cash is starting to move back into the system, because I'm seeing it personally, I know it's go time because I've already gone through this. I went through the Great Recession. We've been doing this for over 20 years. And I know most of our audience is probably around our demographic. So this may be the first recession they've been in where they actually have money. And so when you actually have money and it's the first recession you're in, you get a little fearful. Well, I got destroyed real bad in the last recession. So I already know what happens. And I know in the last recession, all of a sudden I'm sitting there and it's 2010 and the market hasn't even bottomed yet. And you can see the go signals happening. And anyone who started buying by 2010, even though the market depreciated all the way until 2012, killed it. 2010, 11, 12, 13, 14, 15, if you bought in any of those years, because they weren't real estate wasn't really good again until 2016.
So what do you want to tell people watching right now?
Let's have some fun. It's time to go buy some real estate. The data is going to make you feel slightly uncomfortable. We need to keep prudent reserves on the side, and we need to figure out a model that works for you where we can do it safely, conservatively, and yet keep cash deployed where we're not missing out and having an opportunity cost.
All right. Well, next week we're going to talk about what Jerome Powell does on the weekends. Fun.